15 years ago, I met someone I'll call Margaret. She sat across from me in a coffee shop. Retirement was 3 years away. Her portfolio statement covered half the table. "I'm diversified," she said. "Very diversified." I counted the funds. 12 different mutual funds. 4 bond funds, 5 stock funds covering different market caps, 2 international funds, 1 real estate fund. "My advisor said this protects me," she continued. "But here's what struck me as odd. Each fund charged fees. The bond funds held similar government securities. The stock funds? They owned many of the same companies. Apple appeared in 4 different funds, Microsoft in 5. "How much are you paying total in fees?" I asked. She didn't know. This conversation changed my research direction. It led me to examine something most financial professionals avoid discussing: the hidden cost of excessive diversification in small portfolios. What I discovered surprised me. And it might surprise you too. You've heard the advice: don't put all your eggs in one basket, spread your investments, reduce risk through diversification. This advice isn't wrong. It's fundamental to modern investing. But here's what nobody tells you. You can diversify too much, especially if your portfolio is modest. Under $1 million, under $500,000, you're probably overdoing it. Let me show you why. Researchers at the University of Tasmania spent years examining this question. How many stocks do you actually need to diversify properly? Their findings, published in 2013, reveal something unexpected. The average American investor holds between 4 and 11 individual stocks, but mutual fund managers, they hold between 49 and 129 stocks on average. Here's where it gets interesting. Those researchers found that for most investors seeking to reduce 90% of diversifiable risk, you need somewhere between 16 and 73 stocks, depending on market conditions. Not hundreds, not dozens of funds holding thousands of stocks. And yet most small investors don't own stocks directly. They own funds, multiple funds. Each fund already holds dozens or hundreds of stocks. This creates a paradox. You think you're being careful, you think you're being prudent, but you're actually creating 3 hidden problems. First, fee multiplication. Let's say you own 5 mutual funds. Each charges what seems like a modest fee. Maybe 0.50% annually. Doesn't sound like much, does it? But here's how the math works against you. On a $200,000 portfolio, that's $1,000 per year per fund. 5 funds means $5,000 annually. Over 20 years, that's $100,000 in fees before accounting for lost compound growth. Research published by the Investment Company Institute shows the average actively managed equity fund charges 0.66% annually. Some charge over 1%. Compare that to a total market index fund. Vanguard's total stock market index charges 0.04%. On that same $200,000 portfolio, just $80 annually, the difference compounds brutally. Over 20 years, assuming 7% annual returns, paying 0.66% in fees versus 0.04% costs you approximately $87,000 in lost wealth. And that's just one fund versus another. When you multiply this across 5, 8, 12 funds, the damage accelerates. Second, overlap paralysis. Remember Margaret's 12 funds? I ran an analysis. Her 5 stock funds held a combined 847 individual stocks. But after removing duplicates, only 412 unique companies. She owned Apple 11 times, Microsoft 9 times, Johnson & Johnson 8 times. This isn't diversification, it's redundancy. She paid 5 different management fees to own the same companies repeatedly. Research from the CFA Institute demonstrates that for large-cap portfolios, peak diversification happens around 15 stocks. Adding more provides minimal additional risk reduction, yet Margaret's funds collectively held hundreds. Each fund manager getting paid to pick stocks, many picking the same ones. Third, complexity tax. This one's harder to measure, but it's real. With 12 funds, Margaret couldn't easily track performance. She couldn't compare options. She couldn't make informed decisions about rebalancing or tax loss harvesting. When I asked which fund performed best last year, she guessed. When I asked if she should sell the worst performer, she didn't know. Complexity doesn't just cost money, it costs clarity. And clarity is what you need most when markets fall and fear rises. The research on optimal diversification tells a consistent story, one that contradicts conventional financial advice. Mayor Statman's foundational 1987 study suggested investors needed 30 to 40 stocks for proper diversification. That was nearly 40 years ago. Some researchers today argue the number has increased to 50 or even more due to rising market correlations. But here's the critical detail most people miss. These studies examine individual stock portfolios. They ask, if you're picking stocks yourself, how many do you need? Very few small investors pick individual stocks anymore. They own funds. And funds already hold dozens or hundreds of stocks. A 2021 comprehensive review published in the Journal of Risk and Financial Management examined decades of diversification research across multiple markets. The authors found something revealing. The optimal number of holdings depends heavily on the investor's situation. Portfolio size matters, investment goals matter, time horizon matters. For someone with $100,000 to invest, owning 8 different mutual funds, each already holding 100+ stocks, provides no meaningful additional diversification. You've already captured the market's returns. You're now just paying extra fees to replicate what you already own. Australian researchers studying retirement accounts made an even more striking discovery. They examined whether investors benefit from diversifying across multiple funds rather than concentrating in a single fund. They're finding in over 80% of cases investors were better off in one fund than spreading across 2 or more. Why? 2 reasons: fees and overlap. The costs of multiple funds outweighed any theoretical diversification benefit, and the funds often held similar investments anyway. Here's what troubles me most about excessive diversification. It solves the wrong problem. When people load up on multiple funds, they think they're protecting against market crashes. They're not. During the 2008 financial crisis, nearly all stock funds fell. Diversifying across 8 stock funds instead of 1 didn't help. They all declined together. During the 2020 pandemic crash, same story. Correlation across stock funds approached 1 but 0. They moved as a unit. The real risk in retirement isn't owning too few stocks. It's owning too few asset classes. If you own 8 different U.S. large-cap stock funds, you have 8 eggs in the same basket. They're all U.S. stocks. They'll all rise together in good times. They'll all fall together in bad times. True diversification means owning different types of investments: stocks and bonds, U.S. and international, growth companies and value companies, real estate and commodities. But here's the interesting part. You can achieve all of that with 1 or 2 funds, not 12. This brings us to what I now recommend for most people with modest portfolios, especially those over 50 approaching retirement. 1 total market index fund for your stock allocation. That's it. Let me explain why this works so well. A total stock market index fund, like Vanguard's Total Stock Market Index, or similar offerings from Fidelity and Schwab, holds the entire U.S. stock market. Not 40 stocks, not 10 stocks. The CRSP U.S. Total Market Index, which Vanguard tracks, includes approximately 3,500 stocks, large companies like Apple and Microsoft, mid-sized companies, small companies, growth and value, technology and healthcare and consumer goods. You get complete diversification across the entire U.S. stock market. In 1 fund, with 1 fee, and that fee, often under 0.05%. Some funds charge 0 over the past 10 years through January 2026. The CRSP U.S. Total Market Index returned 15.1% annually because these funds charge almost nothing in fees. Investors captured nearly all of that return. Compare that to actively managed funds. The average equity mutual fund returned less after fees, despite professional management, despite research teams, despite complex strategies. The index simply works better for most people. Now, I'm not saying stocks alone create a complete retirement portfolio. You also need bonds, you need some international exposure, maybe you want real estate. But here's the beautiful part. You can achieve that with 1 or 2 additional funds: a total bond market fund, a total international stock fund, done 3 funds, complete global diversification, minimal fees, maximum clarity. If you're sitting here thinking about your own portfolio, you might be wondering, should I consolidate? How do I actually do this? Let me walk you through the practical steps. Step 1. Inventory what you own list. Every fund in your portfolio. Write down the expense ratio for each. Calculate your total annual fees. This alone is revealing. Many people have never done this calculation. When they do, they're shocked. Step 2. Check for overlap. Most fund companies provide portfolio overlap tools. You can see how much your funds duplicate each other. If you own 3 large cap funds and they hold 60% of the same stocks, you're paying 3 times to own the same companies. Step 3. Consider your tax situation. If you own these funds in a retirement account like an IRA or 401k, you can consolidate without tax consequences. Sell the old funds, buy the new ones, no tax bill. If you own them in a taxable account, selling might trigger capital gains taxes. You'll want to calculate whether the tax cost is worth the long-term fee savings. Often it is. Sometimes it makes sense to transition gradually over a few years. Step 4. Choose quality total market funds. Look for funds with these characteristics: extremely low expense ratios, under 0.10% for stock funds, under 0.05% for bond funds. Broad market coverage, total market, not narrow sectors. High asset size, larger funds are more efficient. Minimal trading costs, 3 fund families excel at this. Vanguard, Fidelity, and Schwab all offer excellent total market index funds with minimal fees. Step 5. Set a simple allocation for someone in their 50s or 60s. A common approach might be 60% total stock market index, 30% total bond market index, 10% total international stock index. That's 3 funds, complete diversification. Low fees, easy to understand, simple to rebalance. You can adjust these percentages based on your risk tolerance, more conservative, increase bonds, more aggressive, increase stocks, but the principle remains. Keep it simple, keep costs low, own the market, don't try to beat it. Here's what will happen when you tell your financial advisor you want to consolidate into index funds. They'll resist, not because it's wrong, because it's hard for them to justify their fees when you own a simple 3-fund portfolio. Many advisors earn money in one of 2 ways, either through commissions on the funds they sell you or through a percentage of assets they manage. If you own simple index funds, there's less for them to manage. The funds run themselves. You don't need much advice beyond an annual rebalancing. Some advisors will tell you index funds are risky because they own everything. They'll say active management protects you during downturns. This is generally false. Academic research consistently shows that active managers on average underperform index funds after fees. Some will show you charts of funds that beat the index. This is cherry picking. For every fund that outperformed, many more underperformed, and past performance doesn't predict future results. The evidence is clear. For the vast majority of investors, simple, low-cost index funds outperform complex, high-fee, actively managed funds over time. Your advisor might provide genuine value in other ways. Tax planning, estate planning, behavioral coaching during market volatility, these services justify advisory fees. But complex fund selection, that's often unnecessary when simple solutions work better. I mentioned Margaret earlier. We had that coffee shop conversation 15 years ago. She didn't consolidate right away. It took her 2 years to overcome the emotional attachment to complexity. She believed that 12 funds meant 12 experts protecting her money. But eventually, she simplified. She moved to 3 index funds, total stock market, total bond market, total international stock. Last year, she sent me an email. She's been retired for 12 years now. Her portfolio has grown despite regular withdrawals. Her annual fees dropped from roughly $5,200 to about $180. That's nearly $60,000 in savings over 12 years, not counting compound growth on money she didn't pay in fees. But what struck me most in her email wasn't the numbers. It was this line: "I sleep better now. I understand what I own. When the market drops, I don't panic. I know I own everything, so I know I'll participate in the recovery. The complexity was making me anxious. The simplicity gives me peace." That's the real benefit of escaping the diversification trap, not just better returns, better sleep. If you're carrying too many funds, paying too many fees, dealing with too much complexity, consider the alternative. 1 total market fund, or maybe 3, not 12. Own the market. Pay almost nothing. Sleep well, your future self will thank you.